March 11th, 2013. Nicosia, Cyprus. A senior official at the Central Bank writes a letter to the CEO of Laiki Bank, the country's second largest financial institution. The letter is unambiguous. Any action that reduces, restricts, or blocks depositors' access to their money, it says, contradicts the Constitution of the Republic of Cyprus. 14 days later, the Central Bank imposed exactly that. 8 billion euros. Gone. For the depositors at Laiki, 6 cents returned on every euro. This is not fiction. This was Cyprus 2013. And here is what blows people's minds. Most people think Cyprus was a simple bank panic. Too much hot money. Too many reckless depositors. Then an ugly but necessary rescue. Not quite. The forensic record points somewhere colder. The institution that helped lock depositors out had already stated in writing that restricting access to deposits contradicted the Constitution. Then it happened anyway. So start at street level. Ivan Antonov, Limassol. March 25, 2013. A Russian businessman with 1,629,556 yuan at Laiki Bank, not in a trading account, not in some exotic structure. Deposits. Bank money. The kind of money people keep because they believe access is the whole point, but the doors were shut. For nearly 2 weeks, Cyprus's banks stayed closed. Metal shutters down. ATMs rationed. Transfers frozen. The airport stayed open. The banks did not. That difference matters. Because once the banks closed, time split in two. Before closure, a depositor can still make a decision. After closure, the system makes it for him. And that is the real subject of this story, not merely a haircut. Immobilization. Antonov was not standing in line making a bad call in real time. By the time he and his wife returned to Nicosia, the machinery was already moving underneath him. The law, the resolution, the ranking of claims, the silent conversion of a bank balance from your money into loss-absorbing capital. This is the part official retellings blur. Cyprus did not just reveal that deposits above a threshold could be hid. It revealed something worse. The legal and institutional architecture can change while your funds are already trapped inside it. And Laiki was where that became real. To understand why Ivan Antonov's money could be trapped so fast, you have to step back from March 2013 and look at what Cyprus had already become. By the late 2000s, Cyprus was no longer just a small island economy with banks. It was a banking system with an island attached, and that difference is everything. Between 2005 and 2010, bank credit in Cyprus expanded at roughly 24% per year. Private credit reached 27% of GDP, third highest in Europe. For a while, that looked like prosperity. More balance sheet, more lending, more property, more deposits arriving from abroad, more fees, more apparent normality. But scale can hide fragility. If your banking sector grows faster than the productive economy beneath it, you are not building resilience. You are building a machine that must remain liquid, trusted, and externally funded at all times. The moment one of those conditions fails, the country is too small to backstop what it allowed to form. And people inside the system could see pieces of this early. People inside the system would later argue that Laiki's weakness predated the final crisis by years. That matters because it changes the story. The crisis did not begin with the depositor panic in 2013. The weakness sat underneath the apparent success years earlier, hidden by leverage, hidden by growth, hidden by euro membership. Then came the fatal concentration. Cypriot banks bought Greek government debt and expanded into Greece because the trade looked respectable. Same currency area, higher yield, official paper, European paper. Not some fringe instrument flashing red on a retail screen. Sovereign bonds, safe, supposedly. But that safety was political, not forensic. In October 2011, the Greek PSI restructuring hit. and it hit Cyprus like an internal detonation. About 4 or 5 billion euros was wiped from Cypriot bank balance sheets, roughly a quarter of Cyprus's entire GDP. Overnight. Pause on that. This was not a classic run where depositors lost confidence first and broke the banks. The banks were broken by an upstream sovereign restructuring in another country, inside the same monetary project that was supposed to reduce risk, not concentrate it. And that is why Antonov's case matters so much, because by the time he was relying on the word deposit, the asset side of the system underneath that word had already been compromised by decisions he did not make, risks he did not price, and exposures he could not practically see from a branch in Limassol. That is the trap. You think you are evaluating a bank, but you are really underwriting a chain of sovereign promises, regulatory tolerances, and political bargains far outside the branch door. And when that chain snaps, the official language changes very quickly. First, reassurance, then closure, then law, then came the public promise. In early March 2013, President Nikos Anastasiades told the public he would never allow a haircut on deposits. That line mattered, not politically, mechanically, because in a banking crisis, reassurance is not just language. It affects behavior. It changes whether you move, whether you wire out, whether you break term deposits, whether you still believe the category called cash in the bank means accessible property rather than trapped creditor capital. And then the bank shut. This is where the 100,000 euro guarantee enters the story. And most people misunderstand what that threshold actually did. They hear guaranteed deposits and imagine safety in the ordinary sense. Money untouched. Money unquestionably there. Money beyond political reach. But a guarantee is only as strong as the system enforcing it under stress. Below 100,000 euros, depositors at Laiki were protected in the final structure. Above that line, they were not. But that protection did not operate in a clean market with free exit, full information, and functioning confidence. It operated after the banks had already closed, after capital mobility had already been interrupted, and while emergency legislation was moving underneath frozen account holders. That distinction matters. Because if you cannot withdraw, cannot transfer, cannot legally outrun the changing rules, the threshold is no longer just insurance. It is triage. It tells the system who will be preserved first, because preserving everyone is no longer possible. And at Laiki, the result was brutal. Uninsured depositors were not merely inconvenienced. They were converted into the shock absorber, the class that absorbed losses so public money would not go first. In practical terms, many received about 6 cents on the euro. Think about what that means in live terms. Not a portfolio drawdown, not a paper loss you can wait out. A business operating account becomes unusable. Payroll fails. Imports stop. Rent does not. School fees do not. Suppliers do not care what the resolution framework says. They want settlement. This is the part the phrase bail-in sterilizes. It sounds technical, almost elegant, but on the street it means the system reached inside the liability side of the bank and decided that one group of depositors would function as recapitalization material, and it made that decision while those depositors could not move. So when Ivan Antonov left his funds in place, the key question is not whether 106 million euros was above the line. Of course it was. The question is whether that line meant anything once the state, the central bank, and the resolution process were already rearranging the meaning of a deposit in real time. Now return to Ivan Antonov, because this is where the abstract mechanism becomes a documented human sequence. Antonov held 1,629,556 euros in deposits at Laiki. In March 2013, he was abroad. The airports were open. Cyprus still looked, from a distance, like a country in distress but not yet sealed. Then the banks closed. When he and his wife returned to Nicosia, the decisive window was already gone. That detail is easy to miss. People talk about bank crises as though everyone stands in front of the same information at the same moment, then chooses wisely or foolishly. That is not how this worked. Antonov did not sit calmly in a branch and decide to leave €1 6 million in a failing institution after reading the full resolution architecture. He relied on official assurances given in public by the president and by the surrounding machinery of the state. He relied on the ordinary meaning of the word deposit, and by the time reality diverged from those assurances, movement was no longer a practical option. That sequence became legally important later, because the Limassol court would eventually treat those repeated assurances not as political theater, but as causally relevant. A direct reason Antonov did not move his money before the lock fully hardened. That is a very different framing from the standard crisis narrative, which usually puts all emphasis on the emergency itself and almost none on the signals that kept depositors stationary beforehand. And Antonov was not alone. Thousands of depositors were caught in the bail-in machinery. But Laiki's uninsured depositors appear to have suffered the worst outcome of any creditor class in the resolution. That is the hard edge of the story. Not everyone inside a failing banking system loses the same way. Position in the hierarchy matters. Timing matters. Legal category matters. Access matters. So what happened to Antonov was not merely that he had too much money in one bank. That is the lazy lesson. The real lesson is narrower and more disturbing. He remained inside a liability class that could be sacrificed after receiving official reassurance during a period when the state was already approaching a resolution path that would make exit impossible. And once that path begins, your balance is no longer just a balance. It is inventory. A source of internal rescue funding, money the system can redefine before you can touch it. That is why Cyprus still matters now. Not because Antonov was unusual, because he was legible. He showed in one account what the mechanism actually does to a depositor when the language of safety survives longer than the safety itself. Here's the document that changes the entire shape of the case. Before the haircut, before the full lock, before depositors learned what category they were really in. The Central Bank of Cyprus, in a letter sent on March 11, 2013 to Laiki's leadership, stated that any measure reducing, restricting, or blocking depositor access to funds contradicted the Constitution of the Republic and the European Convention on Human Rights. That is not a retrospective moral judgment. It is contemporaneous institutional knowledge. In writing, before the act itself, sit with that. The system did not discover the contradiction after the damage. It named it first. Then there is the second buried layer. The number. PIMSO's March 2013 bottom-up stress exercise for Cyprus put recapitalization needs at roughly €5,007 to €5,007. But Status Sinios, writing in 2014, argued that the number may have been materially overstated, with a lower capital need closer to 200 Narderniots, €4 billion. That gap does not automatically prove bad faith, but it raises a brutal question. Were depositors forced to absorb losses calibrated to a figure that was never independently verified in time, under conditions where they had no ability to exit anyway? And that question matters far beyond Cyprus, because Cyprus was not treated inside Europe as an aberration to be buried. It became a template. In 2014, the European Union adopted the Bank Recovery and Resolution Directive, BAR-RT, and from January 2015, it made bail-in a formal part of the resolution framework across member states. Under that framework, uninsured deposits could sit in the loss absorption chain ahead of public recapitalization. The June 25, 2025 reform deal changed parts of the crisis management framework, but it did not remove that core bail-in logic. That is the modern parallel. Cyprus was the field test. Berard was the embedding. So when you hear that Cyprus was unique, or chaotic, or a one-off, improvised response to a tiny island banking failure, the forensic record says something else. Prototype, not accident. A mechanism first revealed under pressure, denormalized in law across 27 countries on November 8, 2023, in a Limassol District Court ruling. Judge D. Kitsiou did something rare in the Cyprus litigation record. He looked upstream, not only at the haircut itself, not only at the emergency weekend, but at the sequence that came before it, the public assurances, the immobilization, the state's conduct, the central bank's conduct, and Ivan Antonov's reliance on both. The court awarded Antonov 783 tenths, 90. It found negligence by the state, gross negligence by the central bank, and it treated his reliance on official reassurances as a direct cause of his loss. The Attorney General appealed the same day. The case remains live. That matters because it reframes the event. Cyprus was never only about whether a bank failed. It was about when your money stops being treated as money and starts being treated as a resource inside a resolution model. That line can move faster than public language does, faster than news coverage does, faster than your own instincts do. Ivan Antonov learned that in Limassol. After the assurances, after the closures, after the category had already changed. So the survival lesson is not panic early. It is more precise than that. Know your threshold. Know your legal entity. Know which balances are bank liabilities and which assets remain outside the bail-in stack. Do not confuse a statement of confidence with a guarantee of access, and do not assume that because a mechanism sounds extreme, it is unavailable in your jurisdiction. Cyprus showed the method. Bird embedded it, so here is the binary choice. You can keep reading your bank balance as stored property, or you can read it for what it becomes under stress. A claim inside a hierarchy, subject to rule changes you do not control. That choice exists now, not after the doors close,